So, you've heard the term, the stock market. It gets thrown around on the news and movies by that one uncle at family gatherings who suddenly becomes a financial guru after Thanksgiving dinner. But what is it, really? Imagine the stock market not as a single, scary building full of yelling people in suits, but as a giant, global network of marketplaces. It's kind of like a massive farmer's market. Instead of buying apples, carrots, people are buying and selling tiny little pieces of ownership in companies. These tiny pieces are called stocks, or shares. It's a place where regular people, like you and me, can become part owners of some of the biggest and most innovative companies on the planet. On one side, you have companies that need money to grow, build a new factory, hire more brilliant engineers, invent the next must-have gadget. On the other side, you have people with some extra money, known as investors, who are looking for a way to make that money grow over time. The stock market is the grand intermediary, the ultimate matchmaker, that brings these two groups together. It facilitates this exchange of money for ownership, creating a dynamic ecosystem where both companies and individuals can potentially thrive and build wealth together. It's a fundamental engine of modern capitalism, for better or for worse. Let's break it down even further with a simple analogy. Think of your favorite local pizza place. You might be wondering, why would a successful company voluntarily give up pieces of its ownership? It seems counterintuitive, right? If you built a brilliant business from the ground up, why would you sell parts of it to strangers? The answer, in one word, is growth. Companies, much like living organisms, have a fundamental drive to expand, innovate, and become bigger and better. But growth costs money, a lot of money. This process of selling shares to the public for the first time is called an initial public offering, or IPO. It's a company's big debut on the public stage, a way to raise a massive amount of capital all at once. Let's go back to our pizza shop. Let's call it Cosmic Pizza. The owner, let's call her Sarah, has a dream. She doesn't just want a second location. She wants Cosmic Pizza to be a national chain. She wants to invent a self-heating pizza box. She needs money for research and development, for a huge marketing campaign, for building dozens of new stores. Taking out a loan from a bank is one option, but banks charge interest and often have strict repayment terms. By selling shares, Sarah can raise the funds she needs without going into debt. She's trading a portion of future profits and ownership for the cash she needs right now to make her grand vision a reality. This injection of cash from an IPO can be transformative. It can be the fuel that turns a small but mighty startup into a global powerhouse. Think about a company like Facebook, now Meta. It started as a college project. All right, so companies are selling these things called shares. But what is a share exactly? A share of stock represents a tiny, fractional claim on a company's assets and earnings. When you buy one share of, say, the Walt Disney Company, you are not just buying a piece of paper or a number on a screen. You are buying a minuscule piece of everything Disney owns. You own a sliver of the theme parks. You own a tiny fraction of the Millennium Falcon at Galaxy's Edge. You own a microscopic part of Cinderella's castle. You have a claim on the future profits from movies like Frozen or the next big Marvel blockbuster. You become a part owner, a shareholder. Now, owning one share of Disney won't get you a free pass to Disneyland or a seat at the board meetings. Your ownership stake is incredibly small. If a company has 1 billion shares in existence and you own one, you own 1/billionth of the company. However, as a shareholder, you do get certain rights. The most common right is the right to vote on certain company matters, like electing the board of directors. For most small investors, this is like having one vote out of millions, but it's a right nonetheless. You are, in theory, one of the many bosses. The primary reason most people buy shares, though, isn't to vote on corporate policy. It's because they believe the value of that share will increase over time. They are hoping that the company will continue to be successful, earn more profits, and grow bigger. As the company becomes more valuable, the demand for its shares increases, and the price of each individual share goes up. If you bought a share for $100 and the company does well, other investors might be willing to pay $120 for it a year later. If you sell it then, you've made a $20 profit, or a capital gain. This is the fundamental goal of most stock market investing. So we have companies wanting to sell shares and people wanting to buy them. But where do they meet? They don't just post ads on Craigslist. This is where stock exchanges come in. A stock exchange is an organized and regulated marketplace where stocks are traded. It's the official venue, the grand ballroom where all this buying and selling takes place. The exchange doesn't own the shares itself. It acts as a market maker, providing the infrastructure, and it ensures trading is fair, orderly, and efficient. It's the referee and the stadium all rolled into one. Perhaps the most famous exchange is the New York Stock Exchange, the NYSE. When you see pictures of the trading floor with the big bell and screens everywhere, that's usually the NYSE. Founded in 1792, it's home to many of America's oldest and largest companies like Coca-Cola, Johnson & Johnson, Walmart. Another major U.S. exchange is NASDAQ. NASDAQ is younger and all electronic. There's no physical NASDAQ trading floor. It's done by networks of computers. It's famous for tech giants including Apple, Microsoft, Amazon exchanges exist all over the world. London Stock Exchange, Tokyo Stock Exchange, Shanghai Stock Exchange. Each exchange has rules and listing requirements companies must meet. These requirements often include a certain level of revenue and rigorous financial reporting standards. This helps ensure listed companies are legitimate, providing a layer of protection for investors. Section 5. The price is right. So why do stock prices fluctuate? One of the most bewildering things for beginners is watching a stock's price wiggle up and down all day long. 1 minute it's up, the next it's down. Why isn't it stable? The price of a stock at any given moment is determined by one thing and one thing only: supply and demand. It's basically the price at which a seller is willing to sell and a buyer is willing to buy. If there are more people who want to buy a stock, demand, than there are people who want to sell it, supply, the price will go up. Conversely, if more people are trying to sell than buy, the price will go down. So the real question is, what influences that supply and demand? The answer is, well, almost everything. The most important factor is the company's performance and its expected future performance. Did the company just announce record-breaking profits? Demand for its stock will likely surge, and the price will rise. Did they announce a major product flop or that their sales are declining? More people will want to sell, and the price will fall. Investors are constantly analyzing company earnings reports, sales figures, and profit margins to decide if a company is a good investment. But it's not just about the company itself. Broader economic factors play a huge role. If the entire economy is booming, people have more money and they feel confident. They're more likely to invest in stocks, which can push the whole market up. This is often called a bull market. If the economy enters a recession, unemployment rises, and people get scared. They tend to sell their stocks and move their money into safer assets. This selling pressure can pull the whole market down, an event known as a bear market. So, investing in the stock market offers the potential for significant financial rewards, and that's really the main attraction for most people. Over long periods, the stock market has historically provided a higher average return than most other types of investments, savings accounts, bonds. That's the power of compounding in action. When your stocks increase in value and you earn dividends, you can reinvest those earnings to buy more stock, which can then generate even more earnings. Over decades, this can turn a modest initial investment into a substantial nest egg, fund retirement, a child's education, or other major life goals. The reward here is the potential to have your money work for you, growing even faster than inflation. Let's illustrate this reward with our lemonade stand example. Imagine you bought a share in a friend's lemonade stand for $10. The stand becomes wildly popular, expands to 3 locations, and starts selling branded merchandise. A year later, the business is so successful that other people are willing to pay $15 for a share. You've earned a 50% return on your investment. Furthermore, the business is so profitable that it decides to pay out a $1 dividend per share. However, where there is reward, there is always risk. This is honestly the most important rule of investing. There is absolutely no guarantee that the stock you buy will go up in value. The company could make poor business decisions, a new competitor could steal its customers, or the entire economy could falter. If the company performs poorly, the demand for its shares will dry up, the price will fall, and you could lose money. If you bought that lemonade stand share for $10 and a health inspector shuts it down permanently, your share could become worthless. You could lose your entire initial investment. As you step into the world of investing, you'll encounter a whole new vocabulary. It can feel a bit like learning a new language, but understanding a few key terms will make the landscape much less intimidating. We've already touched on some, but let's formally define them. First, as we've discussed, stocks, shares, equities, represent ownership in a publicly traded company. When you own a stock, you are a shareholder. This is the fundamental building block of the entire market, kind of like the atom of this financial universe. It's what you buy and sell in the hopes of generating a return on your investment. Next up is the dividend. A dividend is a distribution of a portion of a company's earnings, decided by the board of directors, to a class of its shareholders. Dividends are most often paid in cash, but can also be in the form of more stock. Think of it as a profit-sharing bonus. For example, if a company makes a profit of $1 million and decides to pay out $200,000 in dividends to its 1 million shareholders, each shareholder would receive a dividend of 20 cents per share. Stable, profitable companies are more likely to pay dividends, making them attractive to investors seeking a regular income stream. Then we have the concept of an index. You'll often hear news anchors say, "The market was up today." But what does the market actually mean? They are usually referring to a stock market index. An index is a statistical measure that tracks the performance of a specific group of stocks. It provides a snapshot of the overall health and direction of a particular market or sector. The most famous one in the United States is the S&P 500, which tracks the performance of 500 of the largest American companies. If the S&P 500 goes up, it means that, on average, the biggest companies in the US had a good day. Other major indices include the Dow Jones Industrial Average and the Nasdaq Composite. Finally, let's formally define risk and reward. In investing, risk is the chance that an investment's actual return will be different than expected. This includes the possibility of losing some or all of the original investment. So, you understand the basics and you're ready to dip your toes in the water. How do you actually start? The first, most crucial step has nothing to do with picking stocks. It's about getting your financial house in order. Build a solid budget. Pay off high-interest debt, like credit card debt. Build an emergency fund. An emergency fund is 3 to 6 months' worth of living expenses in an accessible savings account. This is your safety net. The stock market is for long-term goals, not money you might need next month. Once your financial foundation is secure, open a brokerage account. These are online platforms that give you access to the stock market. For beginners, pick a well-known, low-cost brokerage firm. Do a little research, compare fees. Try the platform's interface to see if it's intuitive. Opening an account is usually straightforward, like opening a bank account. Provide some personal information. Link a bank account to transfer funds. It's less scary than it sounds, I promise. Now for the big question. What should you buy? Don't chase hot tips. Hearing a tip from a friend, seeing a company in the news. Pouring all your money into one stock is incredibly risky. Diversify. Don't put all your eggs in one basket. Consider a low-cost index fund. Or consider an exchange-traded fund, an ETF. S&P 500 Index Fund example. Buy a tiny piece of all 500 companies at once. That gives you automatic diversification. Avoid trying to time the market, selling at the absolute peak, buying at the absolute bottom. Even professional investors can't do this consistently. Use dollar-cost averaging instead. Invest a fixed amount at regular intervals, for example, $100 every month. When the market is down, your $100 buys more shares. When the market is up, it buys fewer. Over time, this smooths out the bumps and lowers average cost per share. Be a tortoise, not a hare.